Welcome, I'm Evan Cooper for Asset TV and Investment News, and in this session of Masterclass we'll be discussing master limited partnerships and the new dynamics of energy in America. Joining me in New York are Michael Clarfeld, Managing Director and Portfolio Manager at ClearBridge. Just a few years ago, the notion that the U.S. could be practically energy self-sufficient would have been dismissed as a pipe dream. But today, you'd have to be nuts not to be awed by our amazing energy turnaround. North Dakota has become America's Saudi Arabia, and natural gas is so abundant that we're debating about what to do with the glut. It's fair to say that at least partial credit for this boom can be attributed to the tax incentives accorded master limited partnerships. Congress codified the tax rules for these exchange-traded limited partnerships in 1987, requiring that companies qualifying for MLP status derive at least 90% of their income from natural resource extraction, transportation, or related activities, and that they pay distributions quarterly. Because MLPs don't pay corporate income tax, and because they pass along limited partners their often considerable depreciation expenses, MLPs can be a pleasingly robust source of income for investors, especially now when returns are so paltry elsewhere. But they can also be a royal pain in the record-keeping department at tax time because of the complex K-1 forms they use instead of the more familiar 1099s. Mutual funds composed of MLPs help solve the tax reporting headache, and our experts will be discussing how that works in a little bit. But first, let's start with an overview of the U.S. energy renaissance. Michael, what's your take on what's going on?
The turnaround we've seen in the last many years has been remarkable. In fact, just 5 or 6 years ago, we thought we were running out of natural gas in the United States. That's why 5 or 6 years ago, we were building terminals to import natural gas because we thought we were sort of going to be in perpetual decline. And now, 5 years later, we're re-engineering those or reversing those facilities to export gas. So it really is a tremendous shift in the perception of America's role in the energy markets. And interestingly, just a couple weeks ago, it was in the papers, I don't know if everybody saw it, but the U.S. is now the largest energy producer in the world, surpassing Russia, which again is something that I think most people at home wouldn't realize, that the U.S. is the largest energy producer in the world, which wasn't the case just a couple years ago.
Let me bring it up because I'm sure it's on the minds of many people, even though it's not the main topic of what we'll be discussing today. These are the ecological concerns and the environmental concerns of drilling, of fracking to get the natural gas, drilling in the Gulf to reach oil. We had the oil spill. How is that played out, and what are the environmental concerns, and how are they being addressed?
Fracking has actually been around for a long time. This is not new technology. The way it's being employed and the extent to which it's being employed is a newer development. And I think naturally, or it's not surprising that people, when there is a new technology, at first they're sort of skittish about it. We do generally think it's safe. And there's also an interesting dynamic here, which is that while people are concerned about the environmental impacts of fracking, we actually don't think that's such a big, that it's an insurmountable issue. There's a real silver lining in what's going on here, and that is that because of the tremendous growth in shale production in the United States, the consumption of natural gas in the United States has grown dramatically, and it's come at the expense of coal. So in the United States, we used to, 50% of electricity in the United States used to come from burning coal, and that's fallen to about the mid-30s and been replaced largely by natural gas. And what that means is that, so almost ironically, the United States was the only country in the world that didn't sign the Kyoto Protocol many years back, which was a global treaty on reducing carbon emissions. So the United States didn't sign it, and we actually don't really have a strong environmental policy. And yet, ironically, we're the only country in the world that has lower carbon emissions today than when Kyoto was signed. And the reason is, it's not because we went out and are actively trying to do this, it's because in sort of the American way, the free market has solved the problem by producing more natural gas, and increased consumption of natural gas is replacing much dirtier energy sources. So there's a real positive environmental story in what's going on in the United States.
Let's get back to the investing portion of MLPs and energy, and go back to the issue of how MLPs work and the tax benefits that accrue to them, and how investors can take advantage of them. Michael, your firm is involved in mutual funds that have MLPs, and Todd, you have separately managed accounts. So what are the advantages, disadvantages of owning MLPs directly, or in an SMA, or in a fund? So, Michael, start with the fund side of things.
So MLPs are attractive for several reasons. I'd say 3 in particular, probably. So the first one is they have strong cash flow and strong dividends or distributions. So the MLP space today yields about 6%. So that's the first thing. The second thing is that they're generally very tax efficient. So that 6% coupon you're getting from MLPs is frequently treated as a return of capital from a tax perspective, so you don't have to pay any income tax on it. And the third thing is that MLPs aren't bonds. So this is not a 6% fixed coupon. MLPs have nice growth. Historically, MLPs have grown their distribution at 5, 6, 7% a year. So it's a real powerful combination. The headache part of MLPs for individual investors comes around the tax filings. So MLPs are partnerships from a tax perspective, and because of that, they issued K1s. And K1s, they're actually not that complicated, but a lot of people don't like getting K1s, particularly people who maybe are filing their taxes themselves or don't have a sophisticated tax help. So there's a couple different products in the marketplace that help people get exposure while offering different ways of doing so. So at our firm, we offer mutual fund products, and mutual fund products are great for clients because they issue, if you invest in a mutual fund, you just get one 1099. So it completely eliminates the K1 aspect, so much simpler tax reporting. The trade-off is some of those returns of capital or losses that MLPs flow through, you can't use. So there are trade-offs to each. We generally find that for most people, the mutual fund is a good solution because it's a actively managed, diversified, simple way to do it. But oftentimes for much higher net worth people, maybe separately managed accounts are an attractive way to do it.
So let's talk about the kinds of investments within each of your structures. What kinds of things do you see? Is oil, gas, what things? Michael, tell us what's interesting now.
Yeah, so I think what's important, I think, for people to understand about MLPs is, generally speaking, the bulk of the industry is focused in an area called what we call midstream. And midstream means it's between sort of the well and the end user. In other words, these aren't the companies that are pulling the oil and gas out of the ground, and they're not the refiner who's turning it into gasoline or propane or some other product. It's the pipeline or storage that's moving the product from the wellhead to the end user. The attractive aspect about these midstream companies, whether, and oftentimes it's not really so relevant actually or as important, is it oil or is it gas, it's that they have stable, predictable cash flows, often with long-term contracts, where they're insulated from moves in the commodity price. So in other words, it doesn't generally matter whether the price of a barrel of oil is $100 or $60. If you're the pipeline company, it doesn't really matter to you because you're charging $3 a barrel to move it, regardless of the price. So the attractiveness of this is, and what we're focused on, are sort of high-quality infrastructure assets with these stable, predictable revenues, good balance sheets, so we know that the distributions they're paying are safe and secure, and good growth profiles, so that in addition to providing us an attractive distribution today, we have a high degree of conviction that they'll be able to raise distribution in the years ahead.
You're saying that, Michael, the business is sort of like a utility, and for the midstream ones, the pipeline companies and stuff. I'm just curious, what do they have to do to, once you build a pipeline, what do you have to do to maintain? Is it an expensive business to be in, or is it just you build it, it's there? And
yeah, so pipelines are in the news a lot today for a whole host of reasons, but the reality is the pipeline's a pretty boring asset. I mean, generally these are pipelines buried in the ground, and they are steel pipes. And the lifespan of a pipe is many decades, so, and not even 2 or 3, oftentimes 50, 60, 70 years, particularly newer pipes. That's not to say that there is no maintenance required. There is, but it is pretty minimal. And it's actually interesting. The industry has a tool. It's called a PIG, Pipeline Inspection
something with a G.
Yes, with a G. And they run these through the pipelines, and there's all sorts of, today they're called smart pigs. Mm-hmm. They have all sorts of sensors. General Electric builds one of the best ones. And all sorts of sensors, so as they're moving through the pipeline, they're able to sense, is there a weakness somewhere, is there a fracture, and if there is, then the company will come out and replace that section. But generally, one of the attractive things about this asset is that once you build it, the ongoing maintenance capital requirements are very minimal. I think one thing that I would add that I think is sort of highlights the driver for this is that much of the shale plays that we're exploiting these days are in geographies that were not traditionally energy basins. So you mentioned North Dakota being the Saudi Arabia of the United States. There's a tremendous oil resource there. Production's growing fantastically. But there aren't a lot of pipes from North Dakota to Chicago, Seattle, pick your place, Texas, because historically it wasn't a huge producing area. So if we just kept finding it in West Texas, which we're actually growing production there too, but if we kept finding oil and gas in the same places we always found it, we probably wouldn't be needing as much infrastructure. But we've got that in North Dakota. The biggest natural gas play in the country right now is called the Marcellus Shale, which is in Pennsylvania. It actually runs under New York as well, West Virginia. There's a big shale in Ohio. So these are areas that have not been oil and gas producing areas for a very long time, and hence that's a big driver of the infrastructure demand, is that the plumbing that we need as a country to move the oil and gas isn't in these places. And so a lot of what's going on is still building that out.
Michael, what would you say to investors?
I think the numbers I would agree with. That's kind of how we think things shake out. You have an attractive upfront yield, 6% today, nice mid to high single digit growth, sets up for a nice double digit growth proposition. I think one of the things that people should be thinking about with clients is so many clients are still, I think, overweight fixed income. And obviously we've started to see an increase in rates and talk of a Fed taper. And we actually think that MLPs are one of the places investors should be for a rising rate environment, because that high coupon upfront means they have somewhat lower duration because of the high coupon, and then the strong growth profile should give a nice offset to rising rates and inflation. So we think it's a very continues to be a very attractive place to be, and from an income perspective, really hard to find anything else in our view with that similar very nice upfront coupon, but that should hold up pretty well in a rising rate environment.
So for, let's say, I know neither of you are advisors and wouldn't give investment advice to an individual, but let's say there's someone in their 50s who has $1 million to invested in a variety of assets. Where does this fit in the portfolio? How much, if you were interested in this and think, gee, the returns are pretty good and the outlook is okay, how much would someone invest in this? In energy and master limited partnerships?
Similar type level, sort of that 5 to 15% range. I think it provides an attractive, another great attribute about MLPs that we haven't talked about is they have little correlation with most other asset classes, so they're a nice portfolio diversifier. So I think at that 5 to 10% rate, you get the coupon we've talked about, the growth we've talked about, you get a nice diversification attribute, and yet at the same time, from a risk perspective, it's not so big that if something negative were to happen, the clients will still be in great shape.
And if the investor had to reallocate, would it come from the fixed income portion, do you think? That where it should come from, or should it come from the equity portion?
I think that's really going to depend on the client, where they are in their life cycle. So I think that's too... I believe very firmly that MLPs are a great asset class for anybody, whether you're 20 years old and just got out of college and started saving, or 22 and just got out of college and started saving, or 75. The combination of income and growth is an attractive combination, and again, given this sort of low correlation to other asset classes. So I think it's great for everybody. How you should think about where to source it from and the exact size might be different based on client needs and where they're at.
We touched on this a little bit, but let's go into a little more. Fed tapering, if it happens, interest rates rise a little bit or maybe more than a little bit, how would that affect MLPs? So the interest rates and the economy, if, let's say, oil prices tend to go down, what these larger macroeconomic factors, how would they affect MLP investments?
I think I think we focus on the intermediate to longer term. So in the short term, anything could happen if rates move sharply higher, and things could happen, sort of short-term volatility. But longer term, we think MLPs are really well positioned, and let me sort of talk about why. So from a tapering perspective, and we actually saw this year. So when talk of taper started in May of this year, MLPs came under a bit of pressure, and it's sort of what I call the day one versus day two phenomena. So day one is rates are rising, sort of shoot first, ask questions later, and sell everything that's income related. But then day two is, okay, if we're actually at the end of this 30-year bull market in bonds and we need to position our clients for portfolios for a rising rate environment, how do we want to position them? And then you're going to come back to, well, we need income growth because that's the only way to keep up with rising rates, and MLPs are right at the top of the list. So that's sort of point one. Point two would be just from a valuation perspective. If you look at where MLPs are today, MLPs today yield 6%. The long-term average is between 6 and 8. So we're within the normal range of where MLPs are traded, a little on the high side, but within the normal range. If you compare that to other income assets, whether it's investment-grade bonds or even high-yield bonds or REITs, all of those are much more than 100 basis points sort of richer against their long-term averages. So we see a lot more price risk in other areas, and actually believe that MLPs don't have much price risk because they're within their long-term average. So that's sort of how we would view that. Your question about commodity prices you also asked was, and that's one of the really great things about MLPs is they're really generally not too sensitive to commodity prices. And I sort of hinted at this earlier in talking about oil pipelines, but pipeline storage assets, they're kind of in some ways like a real estate asset. What I mean by that is generally you're leasing capacity on the asset to the shipper. And so you're saying, well, I'll offer you 10% of this pipeline for your use for the next 10 years, and you pay me X dollars per year. So on these long-haul gas pipelines in particular, whether the client uses the pipeline or not, you get paid the same, so there's not even any volume risk. And there's certainly no price risk because all of these are really capacity related, so how much volume you're offering somebody, and have nothing to do with the price of oil and gas.
And it seems the industry is purely domestic. I mean, domestic producers, U.S. investors who get the tax break. Is there any international interest at all in this because of the yields, even though they don't get the tax breaks, I would imagine, or do they? I don't know. How does it work for international investors, or do they?
So we actually, at ClearBridge, see a lot of interest from international investors. They don't get the same tax breaks, but we manage over $1 billion in MLP for international investors. So, and we've seen that really in the last 18 to 24 months. That's so really a tremendous interest from clients around the world that we've been working with.
It's interesting. Would that international demand help? Does that help the market and boost the prices, or is it's not that significant?
Maybe a tiny bit, but it's not that significant. The MLP, in addition, I think there can be a perception out there that MLPs have grown so fast or are so hot. Am I late to the party, or is it a hot? And I think it's important to put some numbers around that so people understand. So first off, again, the long-term average yield on MLPs is between 6 and 8%. We're currently at 6, so we're in the range of long-term averages. And in terms of sort of new entrants to the market, MLPs, in order to fund their growth, are constantly issuing new equity. And that's a good thing because that means they have growth projects. And over the last couple of years, MLPs have been issuing about $30 billion of equity a year in aggregate for the industry, which means that sort of we need at least $30 billion a year in inflows in the industry just to fund these existing growth projects, or these new growth projects. So it's very much the investor demand is moving really hand in hand with the capital needs of the companies, and it's been very synergistic and positive.
And these 43, are they totally new players or people you already know? What I'm getting at is, let's say in traditional stock analysis, there's so many corporations to choose from, it's hard to get to know everybody. Here it seems like it's a more limited universe, you probably know everybody. Is that's true? Or?
I think there is an aspect of that, and that's a good thing. So I think at 115 names or 117 names, like Todd's saying, it's big enough that you can build a pretty nicely diversified portfolio of names, but small enough that we know all the companies really well and work closely with them. So we have really tight relationships with management and get to speak with them, very regularly and frequently, and I think that makes for better investing. But interesting, sort of some, again, it's the group now is $450 billion in market cap. It's almost the same size as REITs. It's about the same size. So people still have some notion, I think, that MLPs are a new industry or a small niche, however you pronounce it.
You have a choice.
But they're not. It's a really big space. And Kinder Morgan, which is the largest MLP out there, the enterprise value for Kinder Morgan is over $100 billion. It's the third largest energy company in the country behind Exxon and Chevron. So these are not sort of niche industries or small companies. This is a very large industry. And very big, well-capitalized companies.
And you mentioned earlier to me before about an IPO that was kind of big. Yeah. Tell us about that. That's I thought.
Yeah. So one of the interesting things is Plains All America, who has always had a fantastic limited partnership that was publicly traded. Their general partnership was private. They took it public last month, and it was a big deal in the news, but not nearly as big a deal as some other deals we've seen, mostly like Twitter, which comes to mind. And the irony of that is that Plains All America is the largest IPO this year. They raised nearly $3 billion for the general partner. And so this is, again, just reinforces the scale, the size, and the fact that MLPs are, very much a large part of the investing universe today. And also, I think, coming back to Plains All America, a trend we've seen is this increase in these general partnerships, which we find very interesting.
And what about the cyclicality of this, of MLPs? It seems now is the time that when they seem particularly of interest or hot because of the demand. What are there advantages of, if it fits in the portfolio, I guess I was going to ask the advantages of buying it now as opposed to waiting till they're cool, but...
yeah, tell me when that is, and then we'll do that.
But this, in terms of those normal kinds of in favor, out of favor, cyclicality apply to...
I think on the margin, yes, but in the main, no. And what I mean by that is, again, MLPs are within the range of long-term average valuation that they've been at. So again, in a world where interest rates are very distorted and lots of assets are trading at sort of nosebleed prices relative to the long-term averages, MLPs are within their long-term range, admittedly at the higher end, but within the range. And so we don't feel like this is cyclically a bad time to get involved. I think dollar cost averaging in investing is always a good proposition, particularly for managing one's own psychology, so one doesn't get frustrated if they buy something that goes down a little bit afterwards. But I don't think there's any reason that one needs to sort of wait on the sideline. We don't view this, again, this is not a fad. It's not a flash in the pan. This is core infrastructure for the American economy that is being built to last for the next 20, 30, 40, 50 years.